And welcome back, everyone. The latest weekly jobless claims released this morning are higher than expected. Analysts say this is adding to the increasing signs of a slowing job market. So here to break it down for us is Scott Bauer. He is the CEO of Prosper Trading Academy. And thank you, Scott, for joining us today.
My pleasure.
We
Thank you.
appreciate it. Well, first of all, give us an idea of what these jobless claims are telling us.
Sure. So every week, the government puts out a weekly number. And tomorrow, even though it's a holiday, tomorrow we'll get the big monthly number from March. So what this tells us is how robust the job market is, or is it starting to pull back a little bit? And, you know, this really is very important to the Fed and what they ultimately do with interest rates to fight inflation. Because as we know, the job market over the last few years has been extremely robust. There's, you know, it's almost, I don't want to say impossible, it's been very difficult for a lot of employers to find help. So that's starting to slow down a little bit. And that's what the Fed wants to see. It's almost kind of counterintuitive, but that's what they want to see.
So how will this impact interest rates?
Sure. So the number tomorrow is the big one. And if that number is less than what is expected for jobs created, then what the Fed will look at and say, you know what, the interest rate hikes that we have done already, they're starting to take hold. They're starting to have an effect. And so that might lead them to the end of the interest rate hiking cycle. And they're not going to pull back yet, but my opinion is they absolutely will by the end of the year. And
let's talk about young people maybe in the job market.
Sure.
How will this impact them?
Well, you know, anyone looking for a job right now, their jobs are plentiful, jobs are robust, but that's starting to slow down a little bit. So, you know, maybe the ideal job, especially for a younger person, isn't out there right now, but there are jobs available, yet that is going to start getting less and less as time progresses.
And what are some other ways that these numbers are going to impact us, or the cost of housing?
Right, and that's the biggie, right? Because as these interest rates have gone up, we've seen mortgage rates go up from 3% to almost 7% in just a year. They topped out, they are coming down a little bit, but as these job numbers come out, if the jobs market is contracting a little bit, again, that's going to help the Fed ease up a little bit. We should start to see rates coming down.
And what is your take on the recent banking crisis and how big of a deal this is, how long the you know, ramifications might go on?
Sure. Is it a big deal? Yes. Is it a systemic risk to, you know, our whole economy? No, it's really not. Some of the regional banks, meaning the smaller banks, quite frankly, got caught up and in over their heads with managing the risk of what has happened over the last year with interest rates going up as quickly as they did. The big ones, though, the JP Morgan Chases, the Citibanks, Wells Fargo, no issue.
People will be happy to hear that.
Yes, they will.
Okay, well, we want to thank you so much for taking your time out today, Scott Bauer from Prosper Trading Academy. Good to have you with us.
Great to be here.